Okay, let's start today's topic. Okay, so are you able to hear me? Is it audible? Okay then. So now, welcome to another video episode on the same concept called national income accounting. Yesterday, we were under a discussion called how the national income is accounted. Okay, and we come across with one simple task. The thing is, national income is almost it's an income of a country where we have considered only the value of the two monetary value of final goods and services. When the point comes, the final good, then that's the final good which is produced by different producers in a country. Even the same final good produced by the agricultural sector, industrial, as well as the different types of services from a tertiary sector. When we consider all these values, then it will be a too tougher, complex one, rigid one to make others to understand the same concept. Then that is called national income accounting. The same theory propounded when India got independence before making a national income committee in the year of 1948. And they made one simple method of making politicians, first of all, at that time, to understand how it is most important element. Because without knowing the income of a country, we cannot plan any of the expenditure side of a country. Without knowing what is the revenue, it is too horrible to think of what to spend and when to spend and when not to spend. So for that, to frame any kind of a budget, to frame any kind of a macro economic policies, and in general development of the country, it is required for any of the nation to calculate first their country's income, then that is called national income. For that, nobody have digested at initial stage. So what is the income of the country? Then they later on come up across with the one simple element. Then that the element is called a simple economy or two sector model economy. So as like the scientist of some 700-800 years before, in the period of Galileo Galilei, so he tried to explain that the entire the earth is under a round shape. There is a n number of rotations are there in a universal level. So nobody has tried to understand what scientists have said. But the same scientists, they made an experiment of explaining the magnetic field by taking within the four walls in a lab. And they have tried to explain how the neutron, proton, electron, the things will work out at the electronic field. The same thing, economists have tried to explain how the national income should be collected. For that, they made a simple model, then that is called two-sector model, which is also called as a simple economy. This is a simple economy we can define as an economy where there is no place for government, savings and foreign trade. It means an economy which is completely closed one, an economy which is completely dependent on the country itself. It doesn't have any contact with some other countries of the world, right? In such case, then in connection with that thing, they come across with one element, then that is called two sector model economy, and first sector is called the household sector. Okay, next one is called firm sector. So here they made one assumption that the thing is, household sector, they are the owners of the factors of production like land, labor, capital and organization. We, you, everyone, okay, we are providing land, we are providing a labor in the name of employees, okay, we are providing a capital, okay, and everything. So household sector, then the firm sector. Then firm sector will make use of all the factors which is given by the household sector. In such case, how the rotation will go on in a country? For that, so you need to understand a simple circular flow of income. Then that is called a simple economy. So household sector initially they supply the factors of production. Then that is called land, labor, capital, and organization. By making use of all these factors, farm sector will start making the production. When they make a production, then they will supply different types of goods and services. Goods and services. And household sector, for whatever they have supplied, the different factors of production to the firm sector, for that they will make a payment in the form of factor services. Then that is called rent, wages, interest, profit. In the form of factor services. For the land, they will pay rent. For the labor, they will pay wages and salaries. For the capital, they will pay interest. Okay. And for the organization, they will pay profit. In this way, the first income is generated by the household sector. And this income will goes off to the farm sector in the name of payments. In the name of payments or expenses. So in this way, the things will go on continuously as circulated between the sectors, farm sector and household sector. Are we clear? Then this outer circle, which represents real flow. Okay. The inner circle, which represents money flow or income flow. And these two sectors at the year end, some of the statistical departments in a country like CSO, okay, which lies their head office in Mumbai, okay, they will collect continuously information from each district, from each state, what is going on in a country regarding different types of goods and services. And the directly or indirectly they will collect in the form of taxes, they will collect the information in the form of discretionary income, disposable income, and different types of income they are going to collect the information. From that information, they will come to one conclusion, then this is an income of a country. Then there is a simple index which has been made to understand how the income is counted in a country. Okay. So likewise, the point is very clear here, because a nation is filled with the n number of producers, n number of consumers, and again different types of producers. So to count each and every product, that is a too heavy task for economists. For that, to make at that time, to make a separate committee, they made on simple economy model, and this is that model. But the thing is, there are certain methods are there of collecting income in a country. Then the income of a nation, income of a country, can be collected with some of the methods, and those methods are called as measuring methods of national income. Then there is another discussion point of today's class. And those three methods are there, which are popularly, which have been highlighted in your NCERT textbook. Coming to that one, so first one is about income method. Income method. Second one, expenditure method. Third one is about product method. These are the three methods which have been used for measuring of national income. Are you able to hear now? Please, anyone? Is it audible? So that I can ask randomly here and there, so that people can understand. Okay. Okay then. Okay. Thank you. MS Anya, Firdos. Okay, Adil. Thank you. So let's have a discussion with the same methods now. In the worldwide, there are three methods are there of calculation of national income. If you wanted to assess the income of the country, there are three methods are there. So how do you measure the weight of a person, or height of a person, or a number of liters of water? Likewise, if you want to measure the income of an entire country, there are three methods of measuring are there. So coming to the first one, income. Second one, expenditure. Third one, product. And far better, you will understand one by one with the sum of the formulas are there. so that you people can understand. So coming to the among the three, let's go through the first one, income method. See, first one is an income method. If you want to digest income method, then the availability of the data should be clear in a country. Some of the statistical departments, some of the separate organizations which are directly taking an information from the n number of consumers in a country, if they are ready to provide an information regarding of their earnings, then this method is suitable to go for to show first the income of a country. Then that the method is called income method, which concern with the distribution side. Then that the method, it's simply we can express as income of a country can be expressed with the formula called R plus W plus I plus pi. And this is a simplified formula to assess the income of a country. So if you assemble all the income which have been generated by each and every individual of a country in the form of rent, in the form of wages and salaries, or in the form of interest, then in the form of profit. Coming to the first one, rent. So people may earn income in the form of rent, lease, and agreements and all. Then that is should be considered. First one, through the capital gains. Next one, people will earn income by working somewhere or by working on themselves, either by profession, either by an employee, either by any of a source of income in the form of wages, salaries, or any kind of a remuneration that is to be accounted. And third one, people will earn income in the form of interest. Then that interest may be investment, interest generated from an investment, or from bank deposits, or postal departments, or whatever the sources. From any of the sources, what they have collected in the form of interest, either they may invest in the shares or debentures, then that is to be considered. And the last one, how the people of a country will earn the income in the form of profit by either by working roadside shops or any kind of a big companies. So finally they learn some sort of a profit at the end of the year, which is to be accounted in a financial papers or statements. So if we sum up all these, then we can call it as the method which directly gives an information regarding income of a country. But countries like India, where you cannot dig the exact information about particular person because due to n number of seasonal problems like seasonal employment, disguised employment. So where the people is not stick on to the same profession. Sometimes due to the urbanization, most of the rural people will urbanize to the cities and towns to go for a livelihood of their daily earnings. In such case, people can work simultaneously 2 to 3 professions, so one cannot dig the information. So countries like a heavy populated country like India, China and all, so you cannot dig the information regarding the income. So this method, even though one of the method of measuring the national income, this is not a suitable countries like India. An elaborated formula is that of income method, then that is called like this elaborated formula of income method. You can go by either this method or the next one. Then the other one is about sum of total monetary value, sum of total monetary of all individuals equals to I plus WI plus I plus I. You can go by this formula, and there are the 2 to 3 formulas are there. Then that one will discuss when we enter to the offline classes. So there are the number of formulas which we'll discuss when we enter to the calculation part of national income. For time being, you go by this formula that is called R plus W plus I plus 5. This is the first method. If you wanted to understand the second method, then that is an element which enters to the not on the income of the people, then that is an expenses of the people and as well as the government. Then that the method is called expenditure method. Second method which states about calculation of national income, then that is an expenditure. It's a very simple logic lies behind this method, because when people are not able to give the exactly information about what is an income of their earnings, then you can check out instead of income the expenses side of the country. Okay, so that you can easily assess what is an exactly the expenditure done by the people of the country. Then that the method is called expenditure. It means whatever the expenses which have been done by the people of the country as well as the government in a country in a year, if we sum up all the expenses, then that the method is called expenditure method of calculation of national income. And the formula is very simple to remember under the expenditure method. Then that is called C plus I plus G plus net X. So this is the formula which helps us to understand income of a country in some other extended way. Then the formula is called C plus I plus G plus net X. So here what the C stands for? C stands for total consumption expenditure done by the people of the country. See, you and I, we all come under the consumers of different types of goods and services, daily, monthly, weekly. Now and then, we used to spend huge amount of money on different types of goods and services. Then that is a point where which comes under a consumption expenditure done by the people of the country. Then that is abbreviated as C. Now coming to the I. Not only we will spend out of our income only for the consumption purpose, sometimes we used to spend on an investment purpose. Investments on shares, investments on debentures, investment on different securities, investments on gold, investment on a vehicle, investments on different assets which are required, either short term or long term. So at that point, it also comes under investment expenditure. Then that is also comes under expenditure side. Next one is about G. G stands here government. So G is about how a people of a country will spend their money out of their earnings for the daily consumption as well as the investment purpose. Even the government also does the same. Government consumption as well as the government expenditure. Government consumption as well as a government expenditure, that is to be considered under the second method called expenditure method. At the same time, not only the consumption expenditure done by the people of the country and the investment, even the consumption expenditure as well as investment expenditure done by the government as well as the net exports of the country. Net X stands here, net exports of a country, which stands that while doing a foreign trade, you better know the foreign trade, okay, and trade between two or more countries. To do exports or imports, some of expense also included. Okay, it's not a simple task of sending a goods from here to there. So whatever the expenses which have been concerned with that thing, if I excess of exports over the imports, so whatever the expenditure behind the story of exports, that is to be considered. If I add up all the expenses of consumer as well as the investment expenditure, then government expenditure as well as the exports expenditure, then if I add up in a country all these expenses, then the method which states about the expenditure method. And this is the method which generally discuss about the expenditure side of the country, because most of the developing countries will come under this category, because developed countries will come under the income category, but developing countries where the budget is generally a deficit budget exists in those countries, where the revenues are low and expenses are more, and in such countries where we can dig the information of a expenditure side. But if the government is not stable of providing any kind of information, you cannot adopt any of the method of measuring the national income. Even then, but India is still success in calculating of national income that is around minus 23.9. Moreover, so we will talk later on regarding how the GDP affects on the common man pocket and all. Now coming to the next one, then there is about a third method, then that is called a product method. Third method of calculation of national income, then that is called a product method. See, this method is applicable only for the developed countries, and this is a method where the expenditures are more in a country, deficit budget plans. where this is suitable. But when it comes to the India, where the n number of production has been done, n number of products are processing in n number of stages, in such case, we cannot adopt neither first or second. One has to go by the third method to see the exactly the value of monetary value of final goods and services. For that, one has to go by the third method, and that is called a product method. Again, this product method is classified into two. First one in this is about final good method. Second one is called value added method. First one final good method. Next one value added method. Final good method, you people already heard this story. It's a monetary value of only the final value of goods and services to be considered in the calculation of a national income. That is fine, good. For example, if you already come across with the types of goods, intermediate goods and final goods. When we enter to the intermediate good in the formation of bread, so bread will become a final good, but it has been come across with the n number of stages, from wheat to flour to bakers to bread. Okay, if we consider only the value of the bread in the calculation of national income when the consumer has paid out of his pocket, then that the method is called final good method. Means the product which is readily available in the market, if you consider the market price of that product in the market, then that will be known as a final good method. If you go by stage, it means when a product is crossing with n number of stages, at the n number of stage if the value getting added, then that the method of understanding exactly the cost figure of the product, then that the method is called value added method. Regarding of that value added method, we will go deeper side in the next further classes, because it requires some particular chart with the sum of discussion regarding of the timing. So that is not permittable as to go for in such case regarding of it. So we'll discuss in detail. For that, I'll send one particular chart regarding of it. You refer that chart, and at the same time, when you have an idea regarding that chart, you can easily go by the value added method. I hope you people got understood of today's session. And if there is any still doubts, you can ask. Please, anyone? Still any doubts? Yes? Still any doubts here? Anyone? Where is the screenshot for this one? Yes, any doubts? Anyone? Yeah. Okay.